Mr. Well, are you aware of this company, HFields, and they're doing some work with the MPA in terms of recovering all these debts? Are you aware of that?
Yes, we are very much aware, and we think it's a very positive development. Any infrastructure that helps the banking system to have more control on the commodities they finance is a good, can only be positive. As it is now, banks pay collateral managers. When they lend to BDCs, products come. The collateral manager goes to the tank farm. The tank farm is not just for one BDC. You know, the BDCs don't have their own tank farms. A few of them, I think one or two of them, have their tank farms. But even that, they rent a lot of space to others. So when the collateral manager goes to the tank farm and he says, oh, there's products, whose product is it? Is it the BDC you gave the money to, or somebody else is sharing the tank with that BDC, and therefore the product may possibly not be the product you financed? What HFields, from what we understand, when they engage the banks, what they are trying to do is to give the banks visibility on product movement and exposure. So at any point in time, as product is moving from a tank into another storage, that movement is recorded on a system and is approved at the right levels, and the bank has pure visibility, can follow the product from tank to the OMC to cash, back to the BDC, to the bank. You can just follow like that. And that can really help reduce the impairment risk.
Is it de-risking your exposure to these bulk in terms of their working?
If this system works the way it is designed, it will be a game changer for how banks finance the BDCs.
Is this something that the banks themselves cannot do? Some would say that.
This, you see, it's always good to, every bank invest in an infrastructure such as that. What is the benefit? And it is not just your exposure, it is the ecosystem. So the fact that the BDC came to you does not mean that you don't have exposure of another bank. So if there is an infrastructure that consolidates and gives pure visibility to all players in the chain, it helps the BDC, it helps the bank, it helps NPA, it helps the OMC. If all actors within this chain are doing legitimate business, then the ecosystem becomes de-risked, and banks can then lend safely to the BDCs. For
you, do you see this as a revenue assurance measure, or it's not a revenue assurance measure?
I don't know what angle would that be a revenue assurance. It is more a de-risking for the bank,
for the commercial banks.
For the commercial banks. We are lending, and it's going to give us more control over the commodity that is providing the collateral for the lending. So I'm not sure how that becomes a revenue. Maybe it becomes repayment assurance, if you want to call it
for the
that way.
Banks,
for the commercial banks, it helps us to guarantee that once we've given money to a BDC and products land in a tank, movement of that product wherever it goes, the bank has visibility. The banks approve at some stages before product is lifted. Not that the third party who goes and dips a stick in the tank and says, oh, there's product in there. Meanwhile, that product may not be for the BDC you financed.